If you want to get absolutely stuffed to the gills with wealth, there are a few things about money and investing that you should know. Join me and learn about fundamental concepts of money and investing, including investment options like savings accounts, stonks, and Bitcoin. And if you're a quick learner, feel free to jump around using the chapters below. Investing is essential for long-term wealth accumulation, as it's the only way to combat inflation effectively. Inflation generally refers to the rising cost of a varied basket of goods and services. In the US, the government targets a 2% annual inflation rate, but in recent years, inflation has exceeded this goal. Inflation diminishes the purchasing power of money over time, meaning the money can't buy as much as before. For example, if real estate prices increase by 7% annually, the value of your cash decreases by 7% relative to home values, making property increasingly unaffordable. While cash is stable in the short term, it becomes a liability in the long term as it doesn't generate returns and loses value due to inflation. Stashing significant cash long term is a strategy for numpties. If you do this, you're going to get absolutely steamrolled, which is why we must invest. It's the only way to see our wealth bulge like a chipmunk's cheeks stuffed with nuts. How do you balance saving and investing? The generally accepted advice is to invest anything above emergency funding and near-term expenses, though there are no hard rules. The main point is, don't keep 100% of your wealth in cash for the long haul. Now, when you go from saving to investing, you're going to be putting your money at risk for potential rewards. Typically, the potential profits scale with the amount of risk present. If you were to invest all your money in a savings account yielding 5%, your max return potential would be low compared to high-risk assets, but you'd also have zero chance of getting absolutely destroyed. Conversely, if you ape into every doggy crypto coin you hear about, you'll have massive upside potential, but also a high probability of getting fleeced. Now that we've covered risk and reward, let's have a chat about various investment options, ranging from low to high risk. The lowest risk method to generate a return on your money is through a savings account. As of this recording, a Wealthfront savings account offers an annual interest of 5%, which is a solid return without risk. I'm not being paid to promote them. Savings accounts are ideal for building an emergency fund or saving for near-term expenses like a down payment on a house or car, because you can withdraw it whenever necessary. Additionally, savings accounts are FDIC insured. FDIC insurance is a government guarantee provided to depositors in US banks and savings associations. It safeguards up to $250,000 per depositor per insured bank in case the institution collapses. Next on the list are bonds, and not the badass bond called James. Bonds are investment contracts where you loan money to a government or corporation. In return, you receive periodic payments called coupon payments. When the bond matures, your initial investment is returned, if all goes according to plan. If you're investing in a high-interest savings account, your returns are coming from bonds. The financial institution like Wealthfront takes your money and invests it in low-risk assets like government bonds and gives you a portion of the returns. However, if you're willing to take on a bit more risk for potentially higher returns, you could consider investing in corporate bonds. These offer higher returns than government bonds because they come with a bit more risk. That's because the companies issuing corporate bonds have a higher probability of defaulting or not paying you back. Bond returns or yields are directly correlated with the risk involved. Bonds issued by entities with high credit ratings and a low probability of default are referred to as investment-grade bonds. Conversely, bonds issued by entities with lower credit ratings and a higher risk of default are termed high-yield or junk bonds. Although bonds are generally low risk, they are not risk-free. In recent years, an aggressive increase in interest rates has negatively impacted bond prices. There is an inverse correlation between bond prices and interest rates. As rates increase, the prices of previously issued bonds decrease as their lower yields become less attractive compared to the higher yields of current bonds. Now, I don't want to bang you over the head with too much information, as I'll cover bond investing in depth in a future video. For now, I'll give you a few ways to access investment exposure to various types of bonds. The first method to do this automatically is to deposit cash in a high-yield savings account, as we've already discussed. The next method is to buy government bonds through a website like Treasury Direct, which allows you to buy US government bonds by linking your bank account. The third method to invest in bonds is to buy shares of bond ETFs in your brokerage account. Buying shares of an ETF or exchange-traded fund provides you with investment exposure to that fund's assets, which could be stocks, Bitcoin, gold, or bonds. Every stock and fund has a ticker symbol or identifier for their shares. The ETF with the ticker SGOV invests in US Treasuries with less than 3 months until maturity. Investors in the fund have earned 5.35% in the past year. The fund's expense ratio is 0.13%, or 13 basis points, as those Wall Street big shots would say. This translates to a fee of $13 per 10K invested on an annual basis, which is very good. A higher risk option would be shares of an ETF like USHY, a high-yield US corporate bond ETF issued by iShares. This fund invests in high-yield corporate bonds, which offer higher yields due to having more risk. Over the last year, investors in USHY have earned a return of just over 11%, which is double the return of SGOV. Comparing these two ETFs, we can see that USHY's higher return came with much greater volatility over the last year compared to SGOV. While USHY is investing in riskier high-yield corporate bonds, it holds nearly 1,900 of them, which will ensure you don't get completely and utterly trashed from picking the wrong one. It's time to get on with it, but I'll leave more links in the description below if you'd like to read on about other bond funds. The next investment option higher up on the risk meter is stocks, a go-to choice many have used to become disgustingly rich long-term. A stock represents ownership in a company. When you buy shares, you become a shareholder. Stocks generate returns through dividends and capital appreciation. For example, if you own 100 shares of a company that pays a $2 annual dividend per share, you would receive $200 in dividends each year. But the bigger way to make money with stocks is through capital appreciation. Capital appreciation is when the stock price goes up, allowing you to sell for a profit. The most successful companies see their stock prices rip to the moon, causing investors' share positions to absolutely bulge. For example, early investors in Tesla shares have seen their stock position grow nearly 180 times from 2011 to 2024, which would mean a $10,000 initial investment would have billowed to $1.8 million today. Of course, this would have required the investor to have diamond-handed the shares the whole time. But it illustrates how investing in stocks gives you the opportunity to grow your money at rates higher than inflation. And with high return potential, you don't need to go all in. Like all investments, stocks come with risks. The stock market can be volatile, with prices affected by the economy and news about specific companies. A company can also go bankrupt, causing you to get completely wrecked if you're all in on its shares. So what drives stock price changes over the long term? Stock prices are driven by a company's fundamentals such as revenue, profit growth, and overall financial health. Consistently strong financial performance tends to increase a stock's price, while weak performance can lead to a collapse. Other factors include industry trends, economic conditions, and changes in market sentiment. Stock prices can sometimes become detached from company fundamentals, since stock prices are ultimately driven by supply and demand. Investor sentiment plays a significant role in stock pricing. During periods of euphoria, investors may ape into rising stocks, driving prices higher than the company's actual value. Alternatively, during times of despair, investors selling on fear can flush stock prices below their fair value. Because investing can trigger deep emotional responses, it's wise to keep an eye out for when stock prices may have partied a little too hard, and also when bad sentiment is overblown. So how do you buy stocks? You can start by opening a brokerage account with an online broker. Once your account is set up and funded, you can buy shares of stocks directly. One way to invest in stocks with lower risk is through a stock ETF like SPY. SPY tracks the S&P 500 index, representing 500 of the largest US companies. Buying shares of an ETF like SPY gives exposure to a broad range of companies, giving diversification and reducing the risk compared to investing in individual stocks. Investing in individual stocks presents added risks and rewards. The potential for high returns is greater, as choosing the right stock can lead to massive gains. However, the risk is also higher because your investment is tied to the performance of a single company. If that company's performance bombs, your investment will get destroyed. This presents me a natural opportunity to explain the difference between company-specific risk and systemic risk. Company-specific risk refers to the potential of losses due to a specific company experiencing a slump in performance or engaging in outright fraud. Company-specific risk can be diversified away by adding more companies to a portfolio. Systemic risk, which is unavoidable, relates to macroeconomic factors like recessions or interest rate changes that affect all companies. It cannot be eliminated by diversification. Despite all of this, stocks can be powerful for long-term wealth creation. Historically, the stock market has returned about 7 to 10% per year, outpacing inflation. Over the past year, SPY has returned nearly 30%. And over the past 10 years, SPY has delivered a compounded annual return of 13%. I conducted a brief analysis to illustrate the rolling compounded annual returns of SPY over various holding periods. Here are the results since 2004. The rolling one-year returns for SPY have varied from about negative 50% to a positive 80%. However, examining the 10-year rolling compounded returns, nearly all values are positive. This suggests that these longer-term holding periods have consistently been profitable, despite short-term dumps in the market. The lesson here is that if you're considering investing in stocks, it's wise to use money that you can afford to set aside for a lengthy period, giving yourself the highest probability of seeing your stock investments take a trip to the moon. Let's move on and have a chat about Bitcoin, which I'll call the highest risk of the assets discussed in this video due to its volatility. However, this volatility is a feature, not a flaw. Bitcoin is a digital form of value with no central bank or administrator. It allows direct, permissionless transfers between users. Bitcoins are secured with a private key, which can be converted into a 12 or 24-word phrase, enabling holders to store value with a list of words or memory, as opposed to a trusted third party. Bitcoin operates on immutable rules, including a disinflationary supply capped at 21 million coins. This scarcity means that with about 60 million millionaires globally, not every millionaire can own one Bitcoin. Bitcoin was created by an anonymous figure known as Satoshi Nakamoto, who published the Bitcoin white paper in 2008 and launched the network on January 3, 2009. In the first block of transactions, Satoshi included a message, "Chancellor on brink of second bailout for banks," referencing a headline from the London Times. This message is seen as a critique of traditional banking systems and a call for a more people-driven currency. Historically, governments have devalued their currencies by printing money, leading to long-term inflation. This benefits the wealthy, who own assets that outpace inflation, while the low and middle classes suffer from diminishing purchasing power. Bitcoin aims to provide a fair type of money for everyone, and is now supported by millions worldwide. While there are thousands of cryptocurrencies, each with unique features, Bitcoin is the largest and most widely recognized, and the only one truly decentralized. The bullish case for Bitcoin centers on its potential to suck value from the world's existing store of value assets, including real estate, stocks, bonds, gold, and money itself. Bitcoin's unique properties make it an attractive alternative to traditional store of value assets, and it's reasonable to envision Bitcoin gaining value from these other asset classes over time. If Bitcoin captures even a small percentage of these other assets, its market cap could swell to tens of trillions. For example, getting to half of gold's current market cap would value a single Bitcoin at around $400,000. With a current price around $70,000, Bitcoin presents an asymmetric opportunity, with potential rewards far outweighing potential losses. Owning some Bitcoin makes sense as its adoption grows. Despite its volatility, Bitcoin has trended upward consistently when looking at a logarithmic chart. As more people recognize the rapid increase in government currency supplies, demand for Bitcoin, with its fixed supply and decentralized control, is likely to rise. Like we talked about with stocks, the longer the holding period, the better. I ran the compound annual return data from 2014 to present. Over 4-year holding periods, the worst 4-year compound annual return was a positive 24%. The data highlights that holding Bitcoin for the long term has generated strong returns historically, but in the short term, Bitcoin can experience 20 or 30% dips quite frequently. In this graphic, we can see that in most of the years since Bitcoin's inception, it performed better than every other popular asset class. But in its down years, it was the worst performing of the bunch. Because of this, you need to be absolutely cold-blooded when holding this thing. If you get in over your head, Bitcoin's volatility will have you giving your walls a new paint job with your own vomit. As of January 2024, Bitcoin now has ETFs available for investors to easily access investment exposure to Bitcoin. The biggest of them being iBit, the iShares Bitcoin ETF managed by BlackRock. As of this recording, iBit is up 46% year-to-date in 2024. The fund charges a management fee of 25 basis points per year, a higher fee compared to many of the ETFs we've looked at in this video. While purchasing an ETF provides an easy method to gain investment exposure, it removes important benefits of Bitcoin. These benefits include using it for future transactions, storing value independent of third parties, and holding it without incurring fees. I prefer holding Bitcoin directly, but using ETFs is a convenient starting point for beginners and provides access to Bitcoin in retirement accounts that wouldn't be able to access it otherwise. I'll cover more about Bitcoin in a dedicated video, but for now, I'd encourage you to do more research and consider its potential for your portfolio. And be cautious of those with Bitcoin derangement syndrome. We've covered a lot of ground in this video so far. I'd like to chat about a few more important topics before closing this one out. Let's start with portfolio construction. When constructing your portfolio, it's important to balance risk and return. High volatility, high return positions, like growth stonks or Bitcoin, don't need to be egregious to drive healthy overall returns. Conversely, more stable investments like high-yield savings accounts can take up a larger portion of your portfolio for steady growth and income if you're a bit skittish about taking higher risks. Investment concentration offers the potential for quick, massive growth, but with higher levels of volatility and loss potential. Diversification smooths out volatility and therefore returns in both directions. Younger and less wealthy investors can afford to be more aggressive since they have more time to make up early losses through earnings, while older and wealthier individuals should diversify more to protect their wealth. These are only general guidelines and should be tweaked to your own preference. The next thing I wanted to mention is that when you have zero to little investments, adopt an accumulation mindset. Focus on aggressively growing your investment portfolio by increasing your earnings and savings. With a small account, it's easier to grow your portfolio 50 to 100% per year through additional deposits rather than achieving those returns through investments alone. As your portfolio grows, smaller returns will compound quickly in dollar terms. Thus, building your portfolio base like a complete psychopath through earnings is key early on. A $5,000 starting portfolio compounding at 10% per year for 10 years will grow to about $13,000, which isn't likely to get you excited. But with the same returns and holding period, $50,000 grows to $130,000, an $80,000 increase. And $500,000 would grow to $1.3 million. This illustrates that the more you can increase your base, the more the compounding math works in your favor in dollar terms. Let's wrap up with a chat about interest rates. Interest rates play a large role in investment strategy. Just a few years ago, with interest rates near 0%, savings accounts yielded close to nothing, forcing savers to take on more risk in stocks and other assets to generate any returns. In low-rate environments, higher-risk investments become necessary to achieve growth and pound inflation into the ground. However, as interest rates rise, it becomes possible to generate attractive, risk-free returns in savings accounts and bonds, reducing the need to risk getting destroyed in stocks or crypto in search of returns. The point is, as an investor, you'll need to pay attention to changing interest rates, as they will alter your opportunities greatly. My name is Wealthmore, and I hope to see you in another video soon. Until then, go touch some grass, bathe in the low solar angle sun, and enjoy some fine company.